welcome back to my channel. It's Lola here. If you're new here, I talk about money, investing, and how to actually build long-term wealth without getting lost in all the complicated finance talk. And today we're answering a big question. If I were starting to invest in 2025, how would I do it? Spoiler, the best time to start is always now. A lot of beginners struggle with three major problems. First, fear. Many people are scared of losing money or making mistakes, so they never even start. Second, motivation. If you don't see progress right away, it's easy to give up. And third, probably the biggest one, people think they don't have enough money. But here's the thing, you don't need thousands to start. If you invest just $100 every month and get an average return of 10% per year, it'll take around 22 years to hit your first $100,000. That sounds like forever, right? But here's the magic of compounding. After that, the next $100,000 takes only about 6 years. And once you reach $1 million, a 10% return gives you another $100,000 in just a single year. That's how powerful compounding really is. Of course, the question is, where should you invest? There are tons of asset classes, real estate, crypto, precious metals. But the truth is, the higher the potential return, the higher the risk. And if your goal is to build wealth long-term without gambling, then you need something with a balanced risk-to-reward ratio. That's where stocks come in. By buying shares, you become a co-owner of a company and benefit directly from its growth. Historically, U.S. companies have grown their profits by around 8% per year, and when profits grow, stock prices usually follow. At that pace, they double roughly every 9 years. But, and this is important, I wouldn't start with individual stocks. Picking winners is super hard and risky. Instead, I'd follow the advice of John Bogle, the founder of Vanguard, and basically the father of index investing. He said, don't look for the needle in the haystack, just buy the whole haystack. That's exactly what an ETF does, an exchange-traded fund. Instead of betting on one company, you invest in hundreds or even thousands at once. That way, your risk is spread out. Want exposure to the US market? You buy the S&P 500. Want global coverage? There's the MSCI World or even the MSCI All Country World Index, which includes both developed and emerging markets. And the cool thing is, ETFs save you time. You don't need to study balance sheets, watch the markets every day, or guess which company will win. You just invest, stay consistent, and let compounding do the heavy lifting. Now let's be real, ETFs are not risk-free. The stock market can go through long downturns. After the dot-com crash, it took 7 years to recover. After the financial crisis, around 5 years. Even after the oil crisis in the 70s, it took a whole decade. But the important thing is, the global market always bounced back, which is why consistency is key. And here's a mistake many beginners make. They choose ETFs just because they performed best in the last few years. For example, the NASDAQ 100 had insane growth over the past decade, but putting everything into just one sector is risky. Remember the railroads 100 years ago? They were the biggest industry. Today, barely relevant. Technology dominates now, but who knows what the next 30 years will look like. That's why broad diversification is so powerful. With global ETFs like MSCI, ACWI, or FTSE All World, you're basically saying, I don't know which country or sector will win, so I'll own them all. And historically, that strategy worked really well. Now the next big question, when should you start? Many people wait for the perfect timing, but studies show that's almost always a losing game. If you sit on the sidelines, you'll probably miss the best days, which usually come right after the worst days. So the answer is simple. The best time to start was yesterday. The second best time is today. Of course, before you invest, make sure of two things. 1, pay off any high-interest debt first. 2, build an emergency fund covering at least 3 to 6 months of expenses. That way, you won't be forced to sell investments during tough times. And one last tip, stop checking your portfolio every single day. It will drive you crazy. Wealth building takes time. Stay patient, stay consistent, and trust the process. So, if I were starting in 2025, I'd start today. Small, consistent, diversified, and focused on the long game. If this video helped you, please hit the like button, share it with a friend, and don't forget to subscribe for more investing tips with me, Lola. Thanks for watching, and let's grow that wealth together.